Imagine you work hard all year, you see taxes taken out of every paycheck, and at the end of the year, you've paid maybe 20, 25, even 30% of what you earn to the government. Now imagine a billionaire worth $100 billion who sometimes pays a lower tax rate than you. In some years, they might pay almost nothing, and it's completely legal. This is not a conspiracy theory. Leaked IRS data showed that some of the richest people in America paid a true tax rate of only a few percent on the money they made. Meanwhile, your paycheck gets hit every 2 weeks before you even see the cash. In this video, you're going to learn exactly how billionaires pay almost zero taxes in America without breaking the law. You'll see the main moves they use, how the tax code is actually built to help them, and, most important, how you can use small pieces of the same playbook to legally keep more of your own money. And stay with me, because later I'll show you one simple rule that lets a billionaire pass on a huge fortune and wipe out the tax bill with one single day on the calendar. And we'll break down a 3-word strategy called buy, borrow, die. That sounds like a joke, but it's how many billionaires live almost tax-free. So if you've ever looked at your paycheck and thought, why am I paying so much when the ultra-rich pay so little? This is for you. A few years ago, an investigation by ProPublica looked at IRS records of some of the richest people on Earth: Jeff Bezos, Elon Musk, Warren Buffett, Michael Bloomberg, and others. They found that between 2014 and 2018, these billionaires' wealth grew by hundreds of billions of dollars. But the actual federal income tax they paid was tiny compared to that growth. In some cases, a true tax rate of 3 or 4%, or even less. This isn't just about a few famous names. It's about how the entire U.S. tax system is designed. Congress writes the rules. The IRS enforces them. We follow them, often without understanding the game that's really being played. If you only remember one thing from this video, let it be this: the tax code rewards people who own assets and punishes people who only work for a paycheck. Here's where it gets interesting. The first big secret is the difference between income, wealth, and something called realization. Income is the money that comes in every year: your salary, your bonus, your tips. Wealth is what you own: your house, your stocks, your business, your crypto. Now here's the key. In America, we mostly tax income, not wealth. Let's say you own a house worth $300,000. Over a few years, the price goes up to $500,000. On paper, you just became $200,000 richer. But do you get a tax bill every year for that $200,000? No, because you haven't realized that gain. You haven't sold the house. It's all on paper. That $200,000 is called an unrealized gain. The government doesn't tax you on it until you sell. Billionaires play the same game, just with much bigger numbers. Instead of one house, they own giant chunks of companies. Their stock might go from 10 billion to 20 billion to 50 billion in value. But as long as they don't sell, they don't owe income tax on that growth. So while your wages are getting taxed every single paycheck, their net worth can explode year after year with no income tax bill at all. What does this mean for you? If all your money comes from a job, you're playing the tax game on hard mode. If you slowly shift more of your wealth into assets that grow over time, like index funds, real estate, or a business, you get closer to the side of the game that favors owners. But that raises a big question. If billionaires never sell, how do they pay for the mansions, the jets, the yachts, and the private islands? This is where the most famous strategy comes in. It's called buy, borrow, die. Here's how it works in simple terms. Step 1, buy. A billionaire starts a company or invests early in a winning business. They buy shares when they're cheap. Let's say they buy stock worth $10 million. Step 2, the stock grows. Over time, that 10 million grows to 100 million, then a billion. On paper, they just made 990 million in profit. But again, they haven't sold, so no income tax yet. Step 3, borrow. Instead of selling stock to get cash, they go to a bank. The bank looks at that $1 billion in stock and says, "We'll lend you 100 million, maybe 200 million, using your stock as collateral." Collateral just means backing for the loan. If you don't pay, the bank can take your stock. Now the billionaire has $100 million in cash to live on. They buy a house, a jet, they invest in other projects. A loan is not income, so it's not taxed. They might even be able to deduct the interest they pay on that loan as an expense. So they get to enjoy the money now, and they still haven't paid income tax on the gains. Step 4, die. This is the wild part. When they eventually pass away, there's a rule in the US called step-up in basis. Basis is just the starting value the tax code uses to calculate your profit. Remember that stock they bought for $10 million that's now worth $1 billion? When their kids inherit it, the basis gets reset, or stepped up, to the value on the day of death, $1 billion. If the kids sell the stock right away for $1 billion, the tax code says purchase price, $1 billion, sale price, $1 billion, profit, 0. Tax owed on that $990 million of growth over a lifetime? Basically 0, at least on the income tax side. There might be estate tax issues for very large estates, but with good planning, a lot of that can be reduced or avoided too. So the pattern is buy assets, let them grow, borrow against them to live, and when you die, the tax on that growth can simply vanish. Buy, borrow, die. What does this mean for you? Obviously, you're probably not going to borrow $100 million against your index fund, but the idea of being very slow to sell good assets and thinking carefully before realizing gains is something you can use on a much smaller scale. For example, instead of constantly selling and trading, you might choose to hold for the long term and avoid triggering taxes year after year. But buy, borrow, die is only one part of the story. The next piece is just as important, understanding that not all income is taxed the same. When you earn a normal salary, that's called ordinary income. This gets taxed at regular tax rates that go all the way up to 37% for high earners, plus Social Security and Medicare taxes on top. When you sell an investment that you've held for more than 1 year, that profit is called a long-term capital gain. Long-term capital gains are taxed at lower rates, 0%, 15%, or 20%, depending on your income. Even at the very top, that 20% is a lot less than the top ordinary rate. Dividends from some stocks can also be qualified dividends, which are taxed at those same lower capital gains rates instead of higher ordinary income rates. So here's what billionaires and many ultra-rich people do. They structure their lives so that almost all of their money comes from capital gains and business ownership, not from a W-2 salary. Imagine two people each making $10 million in a year. Person A is a superstar employee. They get a $10 million bonus as wages. They could face a tax bill of over $4 million, depending on their state. Person B is a private equity fund manager. On paper, they earn their money as a share of the profits on deals they do, something known as carried interest. Under current rules, a lot of that money can be taxed as long-term capital gains instead of ordinary income. So maybe person B pays closer to $2 million in tax on that $10 million of economic gain. Same $10 million of economic gain, very different tax bill. What does this mean for you? Even if you're not making millions, you can still think about how much of your money comes from wages versus investments. If you're constantly trading stocks and selling within a few months, you might be paying higher short-term rates, which are like wage rates. If you hold quality investments for more than a year, you may qualify for those lower long-term capital gains rates instead. Most investors miss this part. They obsess over picking the right stock, but ignore the giant bite taxes take when they trade too often. But billionaires don't stop there. They also use special wrappers and structures that shelter their income for decades. And here's the good news. Some of these tools are actually available to you too. First, retirement accounts. You've probably heard of a 401k or an IRA. These are tax-advantaged accounts, places where the government gives you a break if you invest for the long term. With a traditional 401k or traditional IRA, you often get a tax deduction now. Your money grows tax-deferred, meaning you don't pay tax on the growth each year. You pay taxes later when you take money out in retirement. With a Roth IRA or Roth 401k, you pay taxes now, but the growth can be totally tax-free if you follow the rules. Here's a crazy example. One famous tech investor reportedly used a Roth IRA to buy startup shares when they were worth almost nothing, fractions of a penny. Those shares later exploded in value into the billions. Because it was inside a Roth, all that growth could be tax-free under the rules at the time. That's an extreme case, but the principle is simple. Put as much as you legally can into tax-advantaged accounts. Let it grow for decades with minimal tax drag. Second, real estate. Real estate has a unique gift in the tax code called depreciation. Depreciation is a paper expense that lets you treat a building as if it's wearing out over time, even if the market value is going up. You can often subtract this depreciation from your rental income, lowering your taxable profit. On top of that, there's something called a 1031 exchange. This rule allows you to sell one investment property and roll the money into another similar property and delay paying capital gains tax. So an investor can trade up from a small rental to a bigger one, and then to an apartment building, each time deferring the tax bill. Again, all completely legal. Third, charities and foundations. Many billionaires move stock into their own private foundations or donor-advised funds. When they donate stock that has gone way up in value, they can get a tax deduction based on the full market value, and they avoid paying capital gains tax on the increase. Meanwhile, they still control how the foundation gives out money, often for many years. You may not set up a private foundation, but you can absolutely use smaller versions of these tools. If you're charitably minded, a donor-advised fund can let you donate appreciated stock, get a deduction, and avoid paying tax on the gain, even with much smaller amounts. What does this mean for you? You probably won't have a $5 billion Roth IRA or a $100 million foundation, but you do have access to a 401k, an IRA, possibly a Roth, maybe even an HSA, a health savings account, which can also grow tax-free if used right. You might one day own a rental property and use depreciation. You might donate some appreciated stock instead of giving cash. Most people never learn these basics. They just accept the default and pay more tax than they need to. But there's still one more piece of the puzzle. How do these billionaire-friendly rules stay in place, and will they last? Tax rules are not fixed forever. Congress can change them, and sometimes they do. There have been proposals to tax unrealized gains for ultra-rich people, to create a billionaire minimum tax, to raise capital gains rates, or to get rid of the step-up in basis at death. Why is it so hard to change? First, very wealthy people hire lobbyists and lawyers to protect their interests. They donate to campaigns. They argue that certain rules are good for investment and jobs. Second, many of the rich people rules also help regular people just on a smaller scale. For example, step up in basis doesn't just help billionaires. If your parents bought a house for $50,000 that's now worth $400,000 and you inherit it, step up in basis can save your family a lot of tax too. Retirement accounts, home sales, small businesses, all of these use some of the same ideas the ultra-rich lean on. So when politicians talk about closing loopholes, there's often pushback, not just from billionaires, but from middle-class homeowners and retirees as well. So what might the future look like? Let's walk through a few simple scenarios. Scenario 1. Small changes, same basic game. This is the most likely in the short term. Capital gains rates might inch up a bit. Some deductions might be trimmed. The IRS might get more funding to audit complex returns. But the basic pattern, owners getting lighter tax treatment than workers, stays in place for many years. Scenario 2. Targeted rules for the ultra-rich. We could see special taxes on billionaires, or on people with more than, say, $100 million in assets. Maybe an annual tax on unrealized gains above a certain level. If that happens, markets might react, but it probably won't change much for someone building a $500,000 or even $5 million portfolio. Scenario 3. Bigger reform. Every few decades, the U.S. does a large tax overhaul. If that happens again, we could see major changes. Capital gains taxed closer to wages, limits on step-up in basis, fewer special breaks. The key for you is this: tax law changes slowly and usually with a lot of warning. If you pay attention, you'll have time to adapt. The worst position is to ignore taxes completely and be surprised every April. So what can you actually do with all of this? Let's turn this into practical ideas you can consider. Focus on building assets, not just income. Your job is important, but your investments are what can move you toward the owner side of the tax code. That could mean low-cost index funds in a brokerage account, starting a small business, or slowly buying real estate you understand. Be patient. The tax code heavily rewards long-term investing. If you buy a good investment and hold it for many years, you delay or reduce taxes. If you day trade, you not only pay higher taxes, you also compete with professionals who have way more tools than you. Use tax-advantaged accounts to the max if you can. If your employer offers a 401k match, that's usually free money. Understand how much you can put into a 401k, IRA, or Roth IRA each year. If you have access to an HSA and you're eligible, learn how it works. It can be one of the most powerful tax shelters available. Think before you sell. When you sell an investment in a taxable account, you may owe tax on the gain. Sometimes that's worth it. But could you wait a bit longer and qualify for long-term rates? Could you sell in a year when your income is lower? Could you use tax loss harvesting, selling losers to offset gains in a smart way? If you own a home or a rental, learn the basic tax rules. You don't need to become an accountant, but understand things like the home sale exclusion, mortgage interest deductions, and depreciation for rentals. Those are some of the same tools big landlords use, just scaled down. And as your wealth grows, don't guess. Talk to a tax professional or financial planner who understands this stuff. This is not financial advice, and it's not tax advice. It's education. Everyone's situation is different, and the right move for one person can be totally wrong for someone else. If you only remember one thing from this video, let it be this. The U.S. tax system is built to reward people who own and hold assets, especially businesses and investments, and to tax people who only work for wages. You may not become a billionaire, but you can still play a simpler version of the same game. Billionaires pay low taxes not just because they're smart, but because they understand the rules and they have people helping them. You don't need a team of lawyers to start using the basics. Own assets, think long-term, and use the tax shelters that are already in front of you. Now I want to hear from you. If you could change just one part of the U.S. tax code, what would you change and why? Would you touch capital gains, step up in basis, something else? Let me know in the comments. If you got value from this video, hit the like button so more people can see it, and subscribe if you want more clear breakdowns on money, investing, and the economy. And if you want to go deeper into keeping more of your returns, check out my video on the biggest tax mistakes investors make. It should be on your screen right now. Thanks for watching, and I'll see you in the next one.